Look, it was an eventful quarter on a variety of dimensions, including very volatile financial market conditions. Our businesses, really all four core businesses, managed to trade extremely well in that environment. And I think the really encouraging part of our performance in the quarter was those four core businesses showed exactly the type of trends that we've been talking with investors about for a while. So very solid revenue growth. They were able to manage the risks and the volatility well. There was a high degree of client engagement, again, across all core businesses in a pretty volatile quarter.
So that's great. We want to see European success stories. We definitely want to see European success stories in the banking sector as well, which is such an important bedrock of the broader economy. There is a caveat here, though, when I look at the share price, and I don't know if our fantastic team have a longer-term share price view on this one. And look, it's had a strong rally to 10 euros from those lows of around about 8, which is the 52-week low. In fact, at the height of the crisis, this is a stock which came down to roughly half of where it is now, around about 5 euros per share as well. So it has had a strong rally. The problem is the market is still not buying the valuation story on what is the key metric. And I point this out to our viewers on a regular basis. There are broad metrics which you use for every single company, like an EPS or like a price earnings. But every single sector has its nuances that we'll look at. For instance, if we're looking at subscriber models like Netflix, we'll look at DAU, we'll look at daily average users, we'll look at KPIs in terms of customer acquisition costs. But in this sector, we look at the price to book. It's the key measure when you're comparing like for like across the board. Now, the key measure in the United States trades significantly above 1 for the price to book. Now, that might be an interest rate scenario. It might be a banking environment scenario. It might be the fact they've got more investment banks out there. But in Europe, the average level is somewhere in the region of 0.8 to 1. This company still trades, despite that rally that I've just mentioned, at 0.36. And as I mentioned earlier on, it trades with Credit Suisse for the let's be honest about it, one of the worst valued stocks in Europe on a key performance measure. So yes, I hear what Herr von Moltke is saying, and I'm pleased that Deutsche are doing well. It's great if they're getting through some of their huge legacy issues, but it is still a highly undervalued stock, and that means that the market is sceptical about the broader growth story.
It's just been a very difficult couple of years, hasn't it? I mean, if you think about what played out on the back of the pandemic, the banks were so fixated on credit losses, having been through many crises before. They were concerned about what was coming on some of these loan portfolios. But of course, we had a lot of government stimulus and support, so we didn't get the same level of credit losses as we may have typically suffered in that type of a downturn. So all the provisioning that took place was somewhat not really used and then written back to balance sheet. So it's been a very strange couple of years. But then on the other side, we've seen in this monster trading environment, stock prices have gone up, you've seen a huge amount of deals. And now on the flip side of that, you've got very tough comparables. So I just wanted to focus on the investment bank for a bit, where you saw profit really up just 1%. So very slim profitability numbers. Revenue, though, up 7%. If you look at some of the detail here, they talk about that 7% being over a strong first quarter of 2021. They talk about that very high hurdle. But that FIC, this is fixed income and currencies, a core part of the business. So that was up 15%, driven by financing, rates, foreign exchange and emerging markets. They said that actually offset a decline in credit trading. So again, one part of the business where you've seen a bit of a fade on the credit side, the growth in FIC revenues also more than offset a 28% decline in origination and advisory revenues. So we talk about that type of a downward fall in a key part of the investment bank. It does tell you about how they have to reach for other areas of profitability. So they talk about the significant year-on-year decline in equity origination, reflected lower industry fee pools and a backdrop of economic and geopolitical uncertainty. So just a bit more colour there as we talk about the geopolitics and this wide-ranging it's a topic. It does have specific consequences on parts of the business as we talk about origination and advisory fees.
Yeah, and just looking in the round at this sector this morning, I thought it was interesting, those comments from Credit Suisse saying a higher interest rate environment will boost their performance potentially in the longer term at a later stage this year. I thought it was all rather vague as well. But I don't necessarily buy into this NIM story. I never have as well. I get a degree of support from some analysts out there that actually in a higher rate environment, when you have enormous amounts of loan already gone out to the consumer, to countries, to state enterprises, to corporations as well, I worry just as much about loan loss provisions. I worry just about credit quality as well, and the ability to make that net interest margin at a profitable level without it denting the impairments and the delinquencies out there as well. And I think that their history would say it's a very checkered picture rather than a carte blanche improvement when you get higher NIMs. I think
you're right, because the animal spirits equation is there as well. You think about when we have a very low interest rate environment, everybody wants credit, or the banks want to hand out credit. You know, it is an environment where people feel confident. Now we don't have that environment. You can see it not just on the lack of deal making, but even further down the chain. And there's a line in the Deutsche Bank numbers here today where they're talking about further portfolio reduction. Risk-weighted assets are down 3 billion euros to 25 billion euros. Leverage exposure is also down 4 billion. So they're cutting back because
it's a safer bank because of it.
Right.
Less risk-weighted assets, and that's been a real problem that people have looked at Deutsche's balance sheet and say, I don't like this bit, I don't like this bit, I don't like this bit. But the fact of the matter is, when you take off that risk, of course, then you don't get the same degree of level of profitability. You can't have it both ways.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.